Hi, my name is Hillary Sunderland, and I'm the Chief Investment Officer at Beacon Wealth Consultants. And this is your February 2020 market update. Well, markets have sent a clear message in recent days that investors are afraid of the coronavirus. As shown on this chart of the S&P 500 index, markets suffered the quickest correction in stock market history, occurring over just 6 trading days. And this was the worst weekly performance for the market since the financial crisis of 2008. To put things into perspective, the S&P 500 had notched a record high close as recently as Wednesday, February 19th, which is the yellow dot on this chart. And a little more than a week later, the index was down approximately 15% from that high, taking us down to lows not seen since October of 2019 and retracing more than a quarter's worth of gains. So amid such extreme volatility, many investors are understandably a bit anxious and panicked and trying to make sense of what's going on. So that's what I hope to do for you today as we review the performance of the markets during the month of February, as well as what is causing some of this risk-off attitude in the markets. For the month of February, domestic stocks as measured by the S&P 500 were down 8.23%. Small cap domestic stocks, the red bar there, were down 8.42%. International developed markets were down a little bit more, 9.04%. Emerging market stocks were down less, 5.27%, and a lot of that return was less so than other indices, largely due to the fact that emerging markets started to sell off really in January when the coronavirus started to break out in China. Commodity indices were down 5.40%, and fixed income had a nice month as yields plummeted, ending the month up 1.80%, and illustrating the importance of maintaining an allocation to fixed income within a portfolio. So what caused a lot of this sell-off in the markets? Well, a lot of it can be contributed to coronavirus. There was a constant stream of negative coronavirus-related news flow, and the economic and financial panic as a result of that comes mainly from the unknown. A new virus like COVID-19 can only be contained and eradicated at the very beginning of an outbreak, and that's why the World Health Organization and other health authorities had taken great emergency measures to try to contain the virus, such as increased travel restrictions and restrictive quarantines. But the side effect of that is that those travel restrictions and quarantines can create severe short-term economic damage, and that's what's being felt in the markets over the last 2 weeks or so. New information on the coronavirus continues to arrive daily, and the peak magnitude of the epidemic and the full extent of the economic implications are still largely unknowable at this point. But I want to give you an update of where we are a month later since my last market update as it relates to coronavirus. So this chart shows the virus statistics as of February 27th. And the good news is that the daily rate of infection has shown some initial signs of slowing in China, but it's taking significant restrictions on travel and very restrictive quarantines to get us there. In recent days, the troubling news has been that there's been a notable pickup of cases in Japan, South Korea, Italy, and Iran, as well as a rise in cases in the US. We're receiving news of this outbreak regularly, and I'm sure you are as well. And as the date of this recording, 6 deaths have been reported in the US, which are not shown on this chart. Now, there are signs that the scope of the coronavirus will be greater than the scope of the impact of the coronavirus is going to be greater than it was for SARS in 2003. As I stated in my January market update, China is a much larger percentage of the global economy now than it was back in 2003. And so it's really difficult to compare the current outbreak to what we experienced at that time because of that. The other reason why we don't think SARS is a really good comparison to the current outbreak is that COVID-19, while it has a significantly lower fatality rate of 2 to 3% than SARS, which was around 10%, COVID-19 is far more prolific than SARS was, increasing the likelihood that it will persist for much longer. It is highly contagious and has long asymptomatic incubation periods of up to 14 days. So unlike SARS, a significant percentage of cases show only mild symptoms, such as a low-grade sore throat, which carriers may not recognize as COVID-19. And because of that, they may not accordingly take actions to prevent spreading the virus. And so these are just a few reasons why, you may read news headlines that, well, when the SARS epidemic broke out in 2003, the markets came back quite quickly. And while that could still be the case here, depending on how this develops over the next few weeks, it was a very different situation than what we are experiencing now. One of the things I've been hearing many people say is that COVID-19 is nothing to worry about in comparison to our typical influenza season in the US. But I think this is a bit misguided based on the data that we have so far. So unlike the seasonal flu, a vaccine is not yet available. Our current assessment is that no vaccine will be available for at least a year. Moderna, a small gene-based drug maker that has never brought a drug or a vaccine to a market, submitted the first batch of a coronavirus vaccine for review. And the Wall Street Journal recently reported that it'll take until the end of April to arrange the first test on healthy volunteers. So results from that test will not be available until July or August. If that first round succeeds, there would likely be another round of tests for efficacy with the hopes that mass production would begin in 2021. And this is really the timeline that we have as the best case scenario for a vaccine. And we don't believe we should pin our hopes on a near-term preventative breakthrough based on what we've seen so far in terms of how long it'll likely take to develop a vaccine. One of the other reasons why it's different than the flu is not only is the majority of the population is not vaccinated against it, but there are treatment constraints as well. So with the seasonal flu, typically between 1.5 to 2% of people in the US need to be hospitalized. For coronavirus, it's quite different. Thus far, about 20 to 25% of people infected with coronavirus become severely ill and require hospitalization. And those that are hospitalized also need to be isolated from the other patients, which can easily overwhelm even the most advanced world health systems. So even though in 75 to 80% of cases, contracting the coronavirus isn't anything worse than the common cold, when 20 to 25% of people, it does affect them greatly and they require hospitalization, that's a very different outcome than what we typically see with the average influenza season in the US. Based on the limited data that we have so far, in terms of fatality rates, and this was quite shocking to me when I first read it, COVID-19 is 20 to 40 times more fatal than the average seasonal flu. The Centers for Disease Control says that 0.05% of people who contract the flu in this is your average flu season over many years, that 0.05% is the fatality rate, and COVID-19 is 2 to 3% at this point. So that's 20 to 40 times more fatal than the average seasonal flu, and it has approximately double the reproduction rate of the average seasonal flu. And so this is important in quantifying how many people are likely to be affected by the virus. Now, this comes with a big caveat, and that is that we only have 2 months of data to work with, and some of the data out of China is a bit suspect. We are not sure that they have been able to diagnose all of the cases of coronavirus. And so when you have fewer cases being diagnosed than there actually are, and then you're putting that in the denominator of the equation to figure out your fatality rate, that makes your fatality rate look much worse than it actually is. So as we get more information, as this hits other countries, that number hopefully will go down in terms of the fatality rate. But this is the information that we have to work for right now. And hopefully putting this data into perspective versus the seasonal flu gives you a better understanding of why governments have responded to this outbreak so strongly. And we've seen vast containment measures in China and are starting to see them in other countries as well, including Italy, where they are now quarantining some towns in Italy and placing increased travel restrictions on different countries around the world. And these measures may be justified to stop the spread, but they're also exceedingly disruptive to economic activity, bringing communities and businesses to a standstill, which is why markets around the world have sold off over the last week or two. The rapid spread of the coronavirus is really a stark reminder that unexpected events can occur at any time. And in finance, we call this a black swan event. A black swan event is defined as an unpredictable event that is beyond what is normally expected of a situation and has potentially severe consequences. And as portfolio managers for your portfolio, we assume that a black swan event is always a possibility and plan accordingly. So for times such as this, we maintain allocations to fixed income as well as alternative investments in our portfolios, as both of these asset classes can help hedge some downside risk. And including these types of investments isn't always popular to clients when equity markets were up as much as they were in 2019, but it is prudent to maintain diversified portfolios by including these asset classes, particularly in times of increasing investment uncertainty. And this approach has proven to be very beneficial over the last several weeks as volatility has picked up in equity and commodity markets. So all this being said, what do we see looking ahead? Well, while the growth impact was initially centered around China and Asia, the spread of the virus is making it more likely that the growth impact extends to the rest of the world. And as each country experiences more cases of the virus, the economic impact grows in both the affected country and also all of the supply chains in which they participate. As of February 27th, over 50 countries have identified people with infections, with confirmed cases in South Korea exceeding 2,300 and Italy topping 600 people infected, demonstrating the global nature of the epidemic. And this makes it very difficult to estimate the economic implications. It's really far too early to assess the ultimate impact of the coronavirus on economic activity and corporate earnings. What I will say is that the sooner the virus is confidently contained, the quicker the recovery will be in economic activity. And governments around the world over the last few days have announced efforts to put stimulus into the economy to try to help prop the economies up during this virus scare. So that should help as well, but the magnitude of those policy initiatives are largely unknown at this point as well. Now, I said earlier that we've looked at health scares in the past to try to model what recoveries could look like, and SARS is one of the more recent ones that we can look at, but is not very comparable to coronavirus given the spread of the coronavirus and the severity it has taken so far. So historically, economies typically experience a V-shaped recovery from pandemics, but we think our base case scenario here is that we're likely to see more of a U-shaped recovery because we really at this point have no idea how far quarantine efforts will go to contain the virus in the US and Europe. And hence we have a lot of uncertainty around the potential downside to growth. And so over the short term, what I'll say is risk aversion is likely to prevail if the number of cases outside of China continues to rise. And while we had a very nice bounce of over 4.5% in the markets yesterday, a great deal of that bounce was in defensive sectors of the economy. So our expectation is for a retest of the lows that we saw at the end of February, or perhaps another leg lower, absent some positive news concerning an outbreak. Typically, that's what happens when markets sell off. You get an initial drop in the markets, a brief recovery, and then a retesting before it starts to either unfortunately go lower or take off again. So we're going to be watching this very closely. And the good news is we're already positioned for increased volatility in our portfolios. We added alternatives in many of our portfolios late last year. We maintain an allocation to high quality fixed income as well. And so our portfolios are holding up very nicely during during the latest market volatility. And we continue to watch this closely and we'll make further changes to the portfolios as warranted. Thank you for your continued confidence, and please reach out to us with any questions you may have.